The more I try to give away, the more it comes back to me. It really does. And, it's one of those little secrets of life that a lot of people never figure out. I don't know why.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hannes Henschel. Welcome back to The Path to Wealth. Today we have Mark Shuler from SGRE Investments. His company has $450 million assets under management, spread over 15 communities, almost 3,000 units, and over 1,000 investors as co-investors. So there is an ocean of knowledge here that he will be able to share with us. Welcome to the show, Mark.
Thank you. Thanks for having me.
So, Mark, where did your journey in real estate start? I know you're an architect and now you're also a multifamily syndicator, but you seem to be deep into real estate. But where did it start?
Yeah, well, it really started, like you said, as been a practicing architect for 35, 40 years now. And along that career path, I just worked with a lot of developers and a lot of a couple of flippers. I don't particularly like the house flip game, so I sort of stay away from that crowd. But, I've done that, and just through, lots and lots and lots of projects, I got exposed to the industry.
Yep.
Also, everybody in my family's in real estate. So I have 5 family members who are commercial brokers, or they are doing development deals of their own. My kid brother is a managing partner of one of the largest accounting firms in the country, and so he's like their real estate guy. He, counsels and teaches, their in-house trainings on real estate taxation, and then he also has a lot of corporate clients that engage him for his expertise in that. So yeah, I just have a lot of exposure to the industry. Got a master's degree in real estate development back in the early aughts, 2002, I think. Went to the business school at the University of Washington. Took me a while to get going with it, but by about 2013, 14, I took the plunge and started doing deals. And like you said, I've done 15, 16 syndications now. Haven't done any ground up development. I prefer the business model of syndication and value add. So that's what I like to focus on.
Yeah. So it looks like it's a natural dinner conversation, real estate in your family.
Yeah. We talk about a lot of deals, that's for sure, in my household.
So how do you handle over 1,000 investors in your database? Like making sure that you actually know you have that personal relationship and kind of take care of them? It's
hard. It's a lot of work. I field phone calls from investors every day. What has helped us is there are a number of kind of investor platforms out there. So the one we're using now is called Juniper Square. It's generally considered to be the probably most sophisticated platform out there. Certainly has a fee that's associated with that. That's very,
sophisticated fee structure for sure.
Yeah. But that has really made investor communication really efficient for us. So we are, we can do like one mass email through that, and it just punches it out to all of our investors, and then they can sign in through their portal and communicate with us that way. All of the tax documents every year are loaded up, on this portal, on the portal page for each investor. Quarterly reports, we put out a lot of quarterly reports. It's a really easy way to distribute those in real time. And so that has cut down on a lot of just, constantly being on the phone answering questions all day long. So, I probably cut down on 80% of the phone calls right there.
Yeah.
We now have an investor relations point person in our firm So all they do is investor relations all day long, and so they're fielding a lot of those phone calls now. So it liberates my time to go out and do the things I like to do, which is find deals, underwrite them. I still do a lot of field work, managing construction. Believe it or not, think a guy like me with my skill sets, that's all I'd be doing. But the higher you climb in the game, the less and less you're the guy out in the field. You're sort of the face of the firm. So that's where you need to expend most of your time.
So talking about investors and kind of segueing into how does the value you add as a syndicator and also kind of bringing in your architectural experience actually translate into the benefits financially for the investors?
That is a big question. I get asked that a lot, but in a different way. So you kind of threw me off here.
But you take it whichever way works for you.
No. Let me explain how most people ask it. I think your way is probably the better question. People ask me, is like, what skill sets do I bring from my architecture career into the real estate game? And I will, my common response is they really don't have much to do with each other. I utilize one set of skills as a practicing architect, and then I use a wholly different set of skills as a deal sponsor and syndicator. There is some overlap in my business skills because I've run a lot of businesses for a long time. So that's a sort of a transferable skill set from architecture into the real estate game because I've always had my own firm. But in terms of my designing buildings in the real estate game, it's not what I do. You would think I would do that, but we're buying and renovating existing assets for the most part. And I might do a quick sketch of how I want to redesign a unit, but that's about it. Yeah. Or I might bring my architectural background to bear on, an insurance claim. And believe it or not, we have tons of insurance claim. I mean, it seems like fires go off every week in apartment buildings. I've had 3 fires in buildings in the last 18 months. So, I'm dealing with that, and that's it's not my favorite thing to do. I hate dealing with insurance companies, but, because of my architectural background, it does give me a lot of insight into kind of where insurance companies, what a surprise. They may try to lie to you. It's like, no, I kind of know this code, and you can't do that. So I can go mano a mano with these insurance companies. That's where my skills as an architect come in really handy. But the day-to-day operations of a deal and, dealing with investors and kind of managing a large organization now, that's just pure and simple management skills. And, maybe as a project manager over, 500 projects, I've learned a thing or two, and that's transferable. But, strictly speaking, as an architect and as a syndicator, they really don't have much to do with each other. My skill sets as an architect brings value, it's probably not what you think. Certainly, I have developed a pretty analytical mindset to evaluate deals, and I certainly have a lot of project management skills that I bring to bear on each of the deals that we renovate. I also have gotten very good at multitasking, spinning a lot of plates simultaneously. That's what I do as an architect. So that is very helpful. A lot of people think they can do that, but until you've practiced it for 40 years like I have, I mean, you get good at it. And you get good at prioritizing what's hair on fire, or in my case, clothes on
maybe
fire.
not hair on fire.
Eyebrows on fire, I should say. Got to get this put out right now, and these other 5 tasks, they can wait. So you get really good at juggling things in your head and just intuitively saying, okay, I got to focus on this right now for the next hour, and I got to get this thing done. So if you've never done that before, or you're just getting in the game, you got to learn that skill very quickly. Because real estate is nothing but jumping around, putting out fires. That's all it is. And, hopefully you put out more fires than start so that you can get to the goal line and create value on behalf of your investors.
Yeah.
So it's a lot, it's managed chaos is what it is.
In your case, sometimes it's putting out real fires.
Yeah, I have a fire inspection tomorrow with an insurance company on a project I own in Mississippi, and they lowballed me $70,000 on a 2-unit rehab. It's like, come on. I know what it costs to rebuild these things. So I did a very detailed cost breakdown, threw it back at them. They finally agreed to go back out and reevaluate it. So I'll get my money. But, if I hadn't had my background and knew exactly what it was going to take to put that unit together, or those 2 units back together, I know the reason why I know that, you might ask, is because I just fixed one a year and a half ago doing the exact same thing. I know exactly what it costs to put a unit back together. It was a lot more than they said.
Yeah.
So, that's kind of how I, and that $70,000 is going to allow me to create, additional NOI in my properties on behalf of my investors. So that's kind of how you connect the dots. Is you're driving it all to the bottom line. Having large data sets tucked away in your, little organic computer here is helpful. It really is.
So how does that translate for some of your investors maybe that are wondering how net operating income translate into value for them as investors? How does that translate?
Okay. Well, you kind of get into sort of biz school 101 here, but the way we value commercial real estate is through in a formula called cash on cap. That's what I call it. So it's value is simply the net operating income divided by the cap rate in that given marketplace for that asset type.
Yeah.
So a lot of multifamily is trading, somewhere between 4.5 and 5 cap right now nationwide, and so the goal is to increase the NOI as much as possible. And NOI is comprised of a lot of things, but basically it's income and expense. So it's the spread between your income and expense for the profit for the property. So the more you can decrease expenses and increase income on the property, the more valuable the property becomes. It's profitability. It's a measure of profitability. You can get deep into the weeds about what goes into NOI, and then you can start having these like esoteric discussions about, above the line versus below the line, but the basic idea is, NOI is your gross income less your expenses to operate the property, ordinary operating expenses.
Having dealt with so many investors, did you feel that's a very common thing that you had to explain to them? How the value is created and kind of, beyond just appreciation of the asset?
Yeah, it is. That's actually a really insightful question. I think most investors, their sense of real estate investing when they want to be the dude, to be the quarterback, they think they go out and buy a building and then just they manage it. And, they rent it up and they've got all this income coming their way, and I can assure you it is way more complicated than that. And it is not the case that just because you buy an asset, you're going to make bank. I was just evaluating a huge deal in Detroit yesterday. And I have a brother who lives there, so I, asked him to drive by it and give me some boots on the ground eyeballs on it. And, it's in this area that you want it to be nice, but, I don't know if you know anything about Detroit, but, a few places, I don't want to bash Detroit too much, but, let's just say it's the only municipality in the history of the United States to go bankrupt, okay? That should tell you something. And so there are a lot of areas of the city which are still down and out, and I was going to hope it was in a decent area of the city. It's a place called Palmer Park. which is a really nice single-family community. Unfortunately, it's not. It's not a nice area. So, I'm taking a look at this and just doing some high-level analysis in my head, and I find out these fools paid $50,000 a door for this place. I came up with like $3,500 a door that I was going to offer.
Yeah.
So it is not the case that just because you buy something, you're going to make money. I mean, you're just forever upside down and in the red on that deal. And, and I talked to the broker, and it's like, I feel bad for these guys, but, I got to take a hard pass on this one. So a lot of people, their impression of real estate investing is buy and hold, classic mom and pop strategy. You rent it, you get tenants in there, and they pay your mortgage payment, and eventually you pay down the mortgage, and you got this pot of gold at the end of the rainbow. That's a strategy. It's not a profitable strategy, in my opinion, because you can get in some pretty crazy math in this line of work, and you're always trying to keep the yield curve, we call it, vertical, and that's the internal rate of return. You're trying to keep the rate of return on the asset as high as possible, and the only way to do that is through leverage. So you want to keep the property pretty leveraged up, and without taking excess risk, too much risk on behalf. You don't want to risk your investors' money, but you want to, at the same time, it's a fine balancing act between risk and being too conservative. And so the buy and hold strategy is like the ultimate in conservative strategies. I mean, buy, you manage, eventually you sell. We can't do that because our deal velocity is so high. We need to be turning these properties and paying dividends to our investors. And the only way to do that is through leverage and risk. So, so that's a long-winded answer to the NOI question. But, we're always trying to increase the NOI to keep the rate of return really high for our investors. And so we manage that pretty intensely. So
how do you currently mitigate the risk? We've seen certain trends with the interest rates, and so basically the risk we're taking on right now seems to be significantly higher than just 6 months or 12 months ago. And how do you manage the current environment?
Yeah, I don't know if the risk is necessary. Well, it's risky if you don't know what you're doing, but. What's really happening is that sellers of assets right now missed the boat. The Fed raised interest rates. They should have sold 6 to 9 months ago. That's what we did. We sold 7 deals, 9 in the last, I think we closed them all about 3 months ago, just before the Fed started raising rates. Got them sold, locked in our profits, and 1031 into new deals. So the challenge right now is sellers who didn't sell back then, they're still selling or trying to sell as if it was interest rates haven't gone up. And the problem is we are underwriting 4 times as many deals as we did a year ago right now, and nothing works. None of the numbers work. None of these valuations that these sellers want to get actually pencil out due to the increased interest rate environment.
But do you also take less leverage right now?
Yeah, we're starting to see less leverage for sure. Depends on the lender, candidly. Obviously you want to take as much leverage as you can, but we were typically at 80% levered on our deals. We do bridge loans to perm after 2 years. So the bridge product was always about 80% levered. Starting to see that, 65 to 70% right now. So now you got to bring more money to the table, and without the leverage, the deals don't work. They just don't work. And so you also are seeing things like rate cap fees. The lenders want a huge rate cap fee. They want huge interest reserves. So you're having to bring a lot more money to the table. And if we're not paying the returns we were a year ago, it's hard to find investors willing to deploy.
Yeah.
So it's a very different game than it was just 12 months ago.
So when you're saying the deals don't work, they don't work for your investors because you have a very high standard when it comes to your internal rate of return.
Yeah, because we're syndicators, we have to bring investor money on board. We have to pay a rate of return on that money. And if we can't pay the rate of return that makes sense for investors to invest in the deal, we don't do a deal. That investor money is what, keeps this machine moving forward. And, if you can't pay, we have historically paid north of 20% IRR on all of our deals, and an 8% cash on cash.
Yeah, which for reference to people that are not that familiar is roughly twice the amount the S&P 500 returns on average.
Yeah. So, and you got tax benefits and bonus depreciation. There's all sorts of benefits to investing in one of our deals, but we can't get 20 IRR right now. I mean, 14, 15, we're seeing a lot of that. And, our cash on cash, the pref has gone down to 6. And we just can't offer that, pony up that deal. I mean, we're just not, investors don't want to invest in a deal like that. They'll sit on the sidelines. And then, sellers do not want to cut their prices. They don't believe that what's happened is their assets are worth 10 to 15% less than they were just 4 months ago. And they're unwilling to accept that as an answer. But that's the reality. So, we're kind of, I've always thought we would hit the pause button for 6 months to kind of let everything settle down a little bit and interest rates settle into kind of their organic where they're supposed to be. They are pulling back a little bit. Sellers are not pulling back on their ask price, though. And, I got time. I can wait. They can't wait. Most of these sellers, they have a note coming due.
Yeah.
And, we'll see who can wait, So, I'll just wait them out, and it's, at some point, this Detroit deal is a classic example. They have to offload that thing, and they're going to offload it for any price they can get. Their problem is they can't get anybody to make an offer. So, but they're going to take a serious haircut. I think $40,000 a door, $45,000 a door haircut. It's 465 doors. You're talking about millions of dollars.
That's a painful
one. It's a painful haircut, and this is supposedly I thought they were a good syndicator, but how the hell do you get that upside down on a deal? I don't know. I mean, but I wouldn't have done that. It's like, jeez.
So what is the...
In their defense,
go ahead.
A big portfolio of assets, and so they're just spitting off things they don't want. So, unfortunately, they paid too much for the entire portfolio.
So they bought it as part of a portfolio. So,
right.
Okay,
they paid $50 a door for the entire portfolio. They should have peeled back the onion a little bit and looked inside the portfolio. And I would have zeroed it right in. Anything that said Detroit, I would have immediately looked at that and said, no. I'm not paying.
I'm surprised somebody's actually blowing money in Detroit. But
well, to give you an example, the broker ran some comps on this deal. The best he could find was $25 a door on the comps. It's like, how the hell do you go pay $50 for something without even comping it? I mean, it's like, what are you thinking? So I can assure your listeners, I don't do that. We put boots on the ground. We research everything to the nines and make sure that we're buying value. There's only 2 ways to make money in this business. You make it on the buy and make it through operations. That's the only 2 ways you make money. If you screw up one or the other, you're cooked.
Yeah. So I'm actually surprised that you, on top of it, are considering Detroit. I think you're the only person in my entire circle that has been bringing up Detroit.
All right. I'll vent my spleen here. I'm an old Detroit boy. There's a part of me that wants to do one deal before I hang up my career, just to give back to my community. Paying it forward is a big thing with me. And so I've always kind of had, casually looked at deals as they come across my desk. Oh, Detroit. Well, let me take a look, And so, believe me, I had this thing vetted in about 3 hours, and I was already off it. So don't take it seriously when I talk about a deal. It's just a good example of what not to do. But I was never seriously considering buying this thing.
So right now, is your investor or your investors are basically fine with you sitting it out, or do you think they're looking for yield elsewhere? What's the sentiment?
That is the question. That's the question. Yeah. If we can't do it, nobody can do it.
That's confidence.
We're vertically integrated, and we have 120 people on the payroll now. All the asset management is done in-house. All the construction is done in-house. So our cost structure is as inexpensive and as efficient as anybody I know. And so if we can't make, and that provides us with a huge competitive advantage over other syndicators, because a lot of syndicators are still trying to third-party manage, third-party build and construct, and they're paying all those additional fees to do a deal that we can operate and renovate for half their cost. That is 5 to 6 points of the bottom line for my investors, right there.
And that's exactly the kind of spread we see on most of the deals going through our mailbox or inbox right now. It's basically that low in the internal rate of return.
I'm sorry. What are you saying? I'm curious.
I said that's also what I'm seeing in the inboxes right now from deals that I get from other syndicators. They're that low in the internal rate of return.
Yeah, I'm not surprised. But I'm telling you, that's our internal rate of return, and we're 5 to 6 points more profitable than other syndicators. Yeah. So if they're telling you they're 14, I'd be suspicious. You really want to vet that out. They may be more like 8 or 9. And and that's just through experience, knowing what your cost structure is. Like, for us to take down a 250, 300 unit deal, I just know how much labor I have to put on the project, what the cost of that labor is. I know exactly how much it's going to cost me to turn each unit, and then maybe all the exterior work. We figure this all out ahead of time. We have a very large spreadsheet where we calculate all this stuff. And, we're once in a while we find something a little more profitable at 16%, but even that, it's not something I feel like I can put out in the market right now.
But wouldn't you rather put out a 16 than nothing right now to keep your investor database engaged?
We dialogue about that a lot. And, when I figure it out, I'll let you know. I don't know the answer to that
When
question.
I get an email from you next week for the next deal, I got my answer.
We have a lot of what-if scenario conversations within our office, my partners. I don't know the answer to that. I'm in uncharted waters here. So, the last time we had something like this was back in the Carter administration, and that's when interest rates climbed to like 21, 22%. We're not anywhere near that, and I do see inflation coming down, interest rates coming
like that.
Yeah, me too. I don't think we are, honestly. I don't think we're going to go anywhere near that. We're at about 6.5 right now on commercial loans, and I have one loan, it's 8%, and even then I'm making money. So I don't know. I just hit the pause button. Everybody needs to calm down, and we'll get back to business here in a few months. I hope. But we have all these external forces the Fed has no control over. We got a hot war in Europe. Yeah. So, and that's having huge impact on grain and oil prices. Worldwide, that is just like wreaking havoc. And what people in the United States need to kind of look at is a chart of inflation around the world. And, the United States inflation rate is like by far the lowest of anybody in the world.
Yeah, actually, I think like a month or two, I posted a post about that where where the US was literally on the lower end, which is kind of scary to think that there are countries who have significantly, some of them 5-7 times higher inflation than the US right now.
That's right. I know. So I don't know. Just to get back to your question, I mean, we'll put out a deal when we deem that the timing is right. You know, I am not willing to risk my investors' money just because I feel like I got to do a deal, I got to do something. That's not how I'm wired. I am a strict fundamentalist in this business, and you know, if anything, maybe I need to take a little more risk, but you know, my business model is I force appreciation. I create value where none existed before. And so, you know, it's a pretty good model if you can manage all the parts, but it's definitely a business model for very experienced operators. Yeah. So when we find a deal that we think makes sense, and we're looking at a lot of stuff right now, maybe we'll find something in the next 2 weeks. I don't know. But when we do find something and we got it underwritten, we'll tee it up and we'll put it out to our investor database. I'm pretty sure we'll find one more deal before the end of the year. You know, it's August. Yeah. We have plenty of time.
I personally think you're pursuing the right philosophy here, and it's more about staying in the game, you know, and ensuring that trust and that fundamentals are in the right place.
Yeah. You got to play the long game.
100%.
And too many. I know of syndicators who are just desperate to do a deal, and that's when you take your eyes off the prize and you make stupid mistakes.
That's when you buy a portfolio in Detroit.
I can't afford to do that. Yeah. Or you're not experienced enough to know what you're doing. So, you know, I've been around the block enough that, you know, it's just, I'm okay. You know, my investors are okay. We'll find something. I'm not going to worry about it.
So what are some of the goals that you have setting into the next couple of years for yourself and your company?
You know, just to kind of keep rinsing and repeating and expand our footprint of our operations. So we're based primarily out in Houston. I used to do a lot of deals here in the Puget Sound where I live. You know, the biggest threat to me as an operator right now is government. And, you know, there's just kind of open season on real estate operators in the Puget Sound. I was just reading an article in the Puget Sound Business Journal this morning, and a lot of operators and developers here have had enough, and so they're selling everything and moving on. City Council will just, you know, say, fine, we don't need you anyways. You know, it's really bizarre for me to see council be this blithe about people like me who provide housing, and we have a critical shortage of housing in the Puget Sound. I mean, it is critical. And the city council just wants to kick us to the curb and, you know, blame us for all of society's ills. And, you know, they have soft rent controls 9 out of 12 months now. You know, it's just like it's made it impossible to do business here. So I don't do business here anymore, primarily down in the Gulf states, where they have a more balanced approach to, you know, business environment there, in my opinion. And so, you know, but look, there's a critical shortage of housing nationwide, so I can go anywhere and, you know, do good, the societal good wherever I go. It's just I've got to find a stable environment where I can count on the rules of engagement, not like the goalpost not being moved every 30 seconds on me, so I can't do business.
And I think that's true for any business environment. There needs to be some stability that the government provides us so we can operate and adjust and adjust business models to it.
Yeah, you know, I agree with you 100%. And believe me, I am decidedly in the middle. You know, I am not an extremist in my politics one way or the other. In some issues, I'm decidedly progressive, and in some issues, I'm decidedly conservative. Ultimately, I'm pragmatic because I run a business, and I have to deal with people's monies, and I don't have the luxury of being, you know, ideological. You know, I got to run the numbers, and it's all a math problem to me. The math either works or it doesn't. So I have to find an environment that allows me to run my business so the math makes sense. And I'm telling you, where I live doesn't make sense anymore. So, Seattle, get your act together. But it's not going to happen. So I've sold everything. I moved on. I like the Deep South. I mean, I'll go down there and, I own a deal in Mississippi. I own a couple of deals in Oklahoma. I own a lot of deals in Houston. We look all across those Gulf states, always. So,
I mean, that's really where it is. And it just, like I said, I've never heard anybody in my circle speak about Detroit, but I give you the pass on that, given that you're from up there.
Hope springs eternal. So
maybe I'm missing something. Maybe it's like a forgotten area that we should all have a second look at.
Well, okay. So this guy the broker was marketing this deal as a 29 cap.
Something I've never heard of.
It's like, oh, come on. What? I know. And so, but when you peel away the sheets, it's like, well, yeah, you've got to go get the historic tax credits, and you've got to get the opportunity zone credits, and this credit and that credit. So all this upside, in the IRR and the cap rate was all on paper. My model, the way I do it is, I like control. I like control a lot, and so I maintain control of everything, and I'm engineering. It's a financial engineering problem for me. So by renovating these units and raising rents, I'm raising the income. That is totally in my control. I don't have any government interference. What this guy was positing on this deal was, you go get the historic tax credit. Well, where do I get that? Well, you got to go to the government and get
Best
that.
of luck.
Well, shit, I'm not going to do that. Opportunity zone credits. Well, I got to go get that from the government. I got to get local tax incentives from the city of Detroit. It's like they're looking for money any way they can. Are they going to give that to me? So all of this upside promised in this offering memorandum, it was all through dealing with government. And for me, that is just like 6 strikes against it. That's all nothing but red marks. It's like there's nothing there. Well, they wanted, they wanted 19 a door in the OM. And I mean, when I say these were dilapidated, I mean they hadn't been inhabited for 25 years. There's plywood over every opening. Every ounce of copper had been stripped out of these buildings. Trees were growing out of the roof, and the roof was collapsed. And they're trying to sell for 19 a door.
That's exactly the picture of Detroit I have in my head. Thanks for confirming it. Yeah.
Well, how did that operator, the guy who bought it and now wants to offload it, how did he miss any of this? Anyways, so.
Yeah, that's a very funny one. So thank you, Mark, for your time. One of the final questions I always love to ask is, what does it mean to you to have a life well lived?
Guy like me who's got more life behind him than he has ahead of him. So for me, it's all about time and relationships. I still work an insane number of hours, but I'm trying to retire or turn down the architecture career so that I can focus on other things. I'm kind of pivoting off of architecture and been doing real estate for about 10 years, and I'll probably do that for another 5 years or so. And but we'll get past this. Maybe we will, maybe we won't. All this discord that's going on worldwide right now. I personally see us in one of those inflection points in history that comes around every 70, 75 years, and humanity seems to lose its mind, and so I happens to coincide just right when I want to retire, but. I look forward to just kind of relaxing a little bit and visiting with people I haven't seen in a while, spending time with my family and grandkids. And, for me, I don't know. I mean, success is defined by people differently, and I don't define my success by the number of toys I have. I could give a rip. I just don't care. And I'm an ideas guy. So, for me, it's about experiences and relationships. So having more time to do that is really what I'm trying to create for myself. And legitimately, I'm trying to create that through, real estate. And you can do it. But it takes a lot of effort and a lot of focus and a lot of discipline. You have to learn a lot about the game, and it takes a minute. You just don't do one deal and you're done. It doesn't work that way. So, I hope to continue this for another few years and really get to what my financial goals are for the reason getting into the business, and then sail off, and enjoy myself. You got 70, 75 good years in this lifetime, and, I'm 62. So I don't want to spend the next 10 years, 15 years as working because I have to. I don't want to have to work.
Yeah, make it optional.
So, I want to enjoy myself. Yeah. But, be thoughtful about it. And Bill Gates has a really good quote about this. And he says, after a while, it's all hamburgers. And if you think about that, I get it. I mean, he's going to give away all of his wealth, all of the billions of dollars that he accumulated over the course of his life. Does him no good, taking it to the grave with him. So he set up this big foundation. He's just giving it all away. I'll see what I do at the end of my life, but I'm already thinking about how much I'm going to give away and how much I'm going to pass on. So. I don't need much. I'm a pretty happy guy.
Does it kind of, excite you to think that you can leave something behind, or also give it away, to have that choice to be charitable in that part of your life?
Yeah, of course. Yeah, I love thinking about that. A legacy. It's not like I got to have my name etched on the side of a building. I could care less about that, but, paying it forward. Giving the next generation or two generations behind me the opportunity to achieve something in their lifetime. So, like, I'm donating to my alma mater. I'm setting up a scholarship fund in my alma mater to help, students who need financial assistance. And that's just one of many things I'm thinking about. I've got grandkids, going to leave some for them, pay for their college education. So, and everything I do has very little to do with me. It's all
awesome.
about what I'm trying to create.
I love it, and that's actually that's very much our journey and why we have the podcast. It's because I think the more people have this kind of abundance in their life, they will naturally turn towards community and kind of like, how can I pay it forward? How can I, uplift other people? That's one of my core beliefs and why we're doing what we're doing.
Yeah, the abundance mentality has always paid dividends to me. The more I try to give away, the more it comes back to me. It really does. And, it's one of those little secrets of life that a lot of people never figure out. I don't know why, but it's like the more you focus on others and not yourself, the richer you become, and that's not just monetarily, but it's emotionally, intellectually. So that's just kind of where I'm at in my life, and hopefully I can go out here,
just drop a big
enjoy myself.
Wisdom bomb of life. That's just where you're at. I love it.
Yeah, maybe.
Well, thank you so much, Mark, for sharing this, and especially the last couple of minutes, like where you are at, and the giving pledge you personally signed up to. I love that part of your journey, and also everything you shared about the businesses and what you're doing and how you're growing them, how you're taking care of your investors. Thank you so much for sharing all of that with our listeners and myself.
Sure, it's my pleasure. It was good talking to you.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.